You're 62 years old, married, and retired, and you have accumulated $300,000 of losses inside of your 401k. The question becomes, is now a good time to convert some of this value to a Roth? That's what we're going to look at with our time today. Hello, my name is John Vandergriff. I am one of the owners and wealth planning team lead at Blue Ridge Wealth Planners, where we help people make plans to transition effectively into retirement through planning and covering many different areas. And then also, if we find people that are already in retirement, making sure that they're not missing something in this planning journey. And so one of those areas that we come across that very often is not planned for in many brokerage relationships or financial advisor relationships is the role of tax planning. And so we're doing, this video in particular today to talk about what kind of advantage we could utilize if we have experienced losses inside of our 401k and how that could be a beneficial thing in terms of Roth conversion. So situation we're looking at is 62-year-old couple that is married and retired, and they have lost $300,000 inside of their 401k, which may be where you're sitting today. But again, we want to look and see if this topic of losses could be something that's beneficial while looking at the conversation of Roth conversions. And as we talk about, a lot of times at the beginning of these videos, we want to recognize that tax planning is just one part of a good retirement plan. It's not the only thing to plan for, just like investments are not the only thing. We need to make sure all of these areas, income, investments, taxes, healthcare, and family legacy, are working together and moving in the same direction. And so as we look at this, we're going to talk today really in the combination of taxes, income, and investments, because again, all these things will be linked together, and sometimes decisions with our investments can benefit us when it comes to taxes. And so as we look at this, a few things before we get into the meat of this. If it's your first time joining us, make sure you like, share, and subscribe this video. And again, if you want to leave comments below, please do so. Let us know what feedback you have. Also, we're going to go into some tax elements today. You may not have a situation that's just like this, so don't make your decisions based purely off this video. And as we always say, if you already know, hey, I've got tax questions, I don't really know who to talk to, you're going to see a link below this video where you can click, schedule a time to talk to one of our wealth planners here at Blue Ridge Wealth. And so again, we would be happy to assist in any of these conversations as you watch this video, or you may want to go ahead and schedule something now. You're more than welcome to do that. So with that being said, look a little bit deeper. So as we said, married couple, age 62. They did have $2 million in their 401k 6 months ago. They're now sitting in a loss of 1.7 or a loss of 300,000. So currently at 1.7 million in their 401ks, $200,000 in the bank. And so what we're looking at is a few factors here, because as we see here, this couple is age 62. They could take Social Security now. And if they were experiencing losses all across the portfolio, that may not be a bad thing, so that they're not in a position where they have to pull $70,000 of income out from lost positions. So we're assuming that in this position that we're looking at today, that inside of this 401k, they have at least $70,000 of money that has not taken a loss. So again, these are some assumptions we're making. So they are taking income from a taxable position, which as we look later will be a good thing to consider, especially with as low as tax rates are now. And then putting off the position to take Social Security gives them time for this check to go up, but also a position where they don't have to. And again, in this position, they actually won't increase their taxable income above 70, just purely from an income perspective. But again, from this, I would say in most cases, it probably makes sense for you to delay taking that Social Security check at 62, but not always. That's one of the things that we look at in income planning, is when is the right time for you as an individual to draw your Social Security check? Because again, it's not a uniform decision for everybody. So as we look at this, we always like to talk about this from a consideration of Roth conversions. We need to understand what it is that we're doing, obviously before we make that decision. And so when we look at Roth conversions, this is moving money out of an IRA or 401k, and we have to know that any dollars that happen in this Roth conversion will be a taxable event for you in that tax year. Now, Roth IRAs need to be in place for 5 years before the money that you convert or contribute in there can have completely tax-free distributions on both principal and the growth on it. Now, if you are over the age of 59, like this couple is at age 62, the principal that you convert is actually available during the 5-year period, but growth in addition to that during that 5 years would be taxable. So if you converted $80,000, you can get to the 80. Any growth above the 80,000 would be a taxable event to you. So as we look at this, we need to understand Roth conversions, but also we need to understand how Roth conversions could be a benefit if you are experiencing a loss. But before we do that, we want to, as we said, outline here that we are choosing not to take Social Security in this position. We're pulling the $70,000 of income out from the savings and choosing to do that from the 401k so that we create a taxable income. We could not do it that way, but we're going to look at what's maybe most beneficial for this particular couple. And again, I've got an opinion here of either pulling income from an after-tax source or using that after-tax source to pay the taxes on the conversion, which I think would be most beneficial as we look at this particular situation. So again, $70,000, if this is their taxable income before any conversion happens, just consuming for their lifestyle, top tax rate would be 12%. As we said, $1.7 million in pre-tax now, $200,000 in after-tax, $0 in tax-free accounts like a Roth IRA or even properly structured life insurance. Both of those can be good vehicles for tax-free growth and tax-free distributions later. So as we look at this, all of the videos that we talk about with Roth conversions need to be built on the basis of if a Roth conversion is in fact good for you to do today or continue on the path that you're on. So we use this example when we talk to people individually. I think it's a good example to illustrate what we're looking at. But what we want to do is say, if we have $100,000 in a 401k, what happens if we leave it alone versus if we take that 100 out and do a Roth conversion? Is that a good decision or not? Well, we've got to look at the factors that affect it. So if we continue to go down a tax-deferred path, no taxes are incurred today, you have $100,000 still in your 401k or IRA balance. The Roth, though, triggers a taxable event for whatever tax year you do this. And if you're in a 20% effective tax rate, and again, what we're looking at today is a little less than that, $100,000 less 20%. If we pay the taxes out of that total, you have $80,000 in the Roth versus $100,000 in the IRA. And so a lot of times financial advisors will use this alone as a basis to not recommend Roth conversions for their clients because they feel like, oh, well, if we're in this position, you have less money, market goes up, you make more money in the 401k than you do in the Roth because more money grows faster. Well, that is true from a math standpoint, but we're not looking at the same numbers because whatever growth we get here is fully taxable. Whatever growth we get here, as long as the account is in place for 5 years, will be tax-free. So we've got to compare if that is a good decision, because sometimes people will stop at that and say that alone is the reason why you want tax-free growth versus taxable. Well, again, it depends on our exit point. So let's assume that we're invested the same way, same length of time. That way the variables we are looking at are not investment related, they are tax related. So we end up with $160,000 in the Roth, $200,000 in the 401k or IRA. Advisors feeling good about their recommendation until we go to take money out. So assuming this is after 5 years, we know that this $160,000 that we put inside of the Roth position is there and available as much or as little as we want to take out of it. And as an additional benefit, any Roth conversions that happen don't qualify under the RMD structure where they have to be taken once you turn 73 and then 10 years from now 75. So you can ultimately leave this account alone or take from it whatever you choose because you've already paid the taxes. Now, 401k, it depends on the tax environment that you're in when you take it out. And even if you don't need it, as we just alluded to, at your RMD required minimum distribution age, you're going to be forced to take this money out on top of any other income sources you have. But if the taxes at the beginning were the same as the taxes are at the end, what you will find is that the bottom line here is exactly the same. So if those taxes never change, it actually does not matter which of these decisions that you make. And I think a lot of us don't understand enough about taxes to know that this is not likely. You know, even if you retire, your income could go down, it could go up. Rarely, though, will your tax bracket stay the same the duration of your retirement years. So as we look at this, we have to look at one of two scenarios and see which is most likely for you. The way that most people plan for their retirement is they just assume once they get to retirement age, their income will drop. Lower income means lower taxes. And if that was the case for you, which is the way most people approach tax planning for retirement, you actually end up winning if you leave this money in the 401k, have more money because your cost to leave the 401k was more than the cost to leave when you converted. And again, if that happened for you, that's the way the math checks out, even though we're getting tax-free growth. So just because we like to hear the words tax-free does not necessarily mean that a Roth conversion is a good thing today. Now, with that being said, we have to kind of catch up with where we are today and understand that not only are we in a position where our income may be the same or go up in retirement, which we see on a daily basis, but even if your income goes down, there's no promise that you won't pay a higher percentage of tax. What's happening right now is a threefold problem. We have already accumulated $31 trillion of debt. We are in the process of accumulating more with the overspending that's happening on an annual basis. And most people don't realize this, but the amount of people that are actually paying taxes is decreasing each year. Whether it's wage monies that people are retiring at a faster rate, or the fact that we're just losing population and we have less overall people to go about paying these tax bills. So less people, more debt. You can do that math, it's probably going to mean more taxes for you. So if that were to occur and your tax rate increases from 20 to 30%, making the Roth decision when your taxes are lowest is what we're after. Because again, as you look at the math here, you're better off in that structure. So again, if we can do that and find the time that is the lowest tax rate possible, that is a win. But if we can combine that with losses in a 401k, then that creates an even better situation. So as we look at this, Roth conversions, when we have a loss, so utilizing this position where let's say you have a stock, and we'll use a singular stock, ETF, or mutual fund, doesn't matter. But all of the losses here, if you go to liquidate them inside of a 401k, you get no credit for capital gains or losses. Everything that's inside of a 401k is income taxable. So the way that you benefit from a loss is by looking at Roth conversions and seeing if we can get more overall tax value from the shares that you own. So as we look here, if you had $100,000 6 months ago, you chose to do a Roth conversion then, and the tax bill for that was $24,000 or 24%, then $24,000 is what you would owe for taxes. Now, if that same position goes down in value $80,000 or to $20,000, $80,000 of value today, you are still at the 24% tax bracket. The overall amount of taxes that you pay is less. And if you do this strategically from an after-tax source, what you've now done is gotten more tax value out of this stock. And if it recoups back to the $100,000 value that you had, that $20,000 of gain is now tax-free. Versus if you left that stock alone, it recouped in the 401k, that's $20,000 of taxable growth, gets you back to a tax bill that is much higher than if you went ahead and realized it now. So this is something, when the market is down, it is a good time to consider Roth conversions, especially if the goal is to continue to hold those same positions. And if you even have a better situation where you can pay those taxes from after-tax money, then really you're not liquidating this stock position at all and able to get, hopefully, a much better tax position moving forward, just if you get back to where you were, and then moving forward, you're able to accumulate more tax-free money. So as we look at this, not only are we in a position where you would pay less taxes, but if you did that same $100,000 conversion, you would actually get more value converted for the same tax dollars. And then if the market recovers, you now had basically more than $100,000 of value that you were able to convert in that one position. So as we look at this, it is important to pay attention to what things that you've lost. And sometimes when we talk to clients, if we're doing a Roth conversion this year, we may strategically look at the investments they have and see which are most benefited by being the first in line of Roth conversion. So that's where, again, we start to factor in the tax element, the investment element, and the income element to make sure that we're really being strategic and trying to provide as much value to an individual's position by maybe converting some positions to Roth first and really taking advantage of current positions. So as we look at this, some people say, oh, I've lost money, that means I automatically need to do a Roth conversion. That's not necessarily the case. We always have to go back to what we looked at in our first example, which is now the right time to pay taxes on this money. So again, with this couple having $70,000 of taxable income before doing any conversions, that would put them in the top tax bracket of 12%, because this is brackets plus a standard deduction. If we look at the way taxes are set to revert back to in the year 2026, that $70,000 would be taxed at 15%, which doesn't sound like a lot, but again, for every $100,000 of money that you have, that's an extra $3,000 of taxes. And then I always throw this up because 1981 was the last time that we had significantly higher taxes than what we've come to experience. Right now, top tax bracket's 37. The last slide we had was 39%. You see top tax bracket here at 70%. And that 70,000, even though we're at the low end of the threshold, is still 6% higher than where we're at today, which doesn't sound like a lot. That's 50% more taxes than those dollars would incur in today's environment. So as we look at this, we see starting distribution today would be at 12%. Starting distribution on that same income would be in 2017 or 2026, and that's not counting the fact that we would probably have more money that we have to take when we factor in Social Security, but then also RMDs in the future, assuming that the 401k does recover back and continue to grow over time. And then we've got 1981's threshold, which is 18, and I think reality may be between these two numbers. Again, we don't know what those are in the future, but I think assuming that income taxes are going to be higher for this particular situation would be a safe assumption, because you got $2 million of money, you only need roughly 1% on it after you take Social Security. No question that $2 million is going to be higher. And again, if it grows to $3 million, you're in a position where you've got 4% a year that you've got to take out of it. That's what, $120,000 of income on top of Social Security, when this situation wouldn't necessarily justify that from an income perspective. So how much to convert now? I think almost a no-brainer situation. You would want to convert at least what's at 12%. If you wanted to go equal parts into 22, that would give you $82,000 converted with an effective tax rate of 17. Most of the people we talk to, we would probably make a recommendation to maybe go higher than this. But again, the nice thing about these numbers is there's no have-to situations. If you have a loss that you're trying to maximize, you may look at that number as a way to make a justification versus the tax percentage overall. But all these things need to be combined in this conversation to make sure that you're making a good decision. And if you've not had at least this much of a discussion with who you're working with, or maybe you do things on your own, we would be happy to sit down with you and see if this type of planning makes sense for you. And if it does, what that could look like if you chose to work with us. But again, we just wanted to understand a little bit more about your situation. So you see a link below. I would encourage you to click that, get on the phone or virtual meeting, or if you're somewhere near Tennessee, come see us in person. But let us get together and see if we can help you in these things, like we have so many families that we get the pleasure of working with. And so again, utilizing your information, working with your tax professionals, making sure that we know all the things that we need to when it comes to your situation is really important when we factor in this. But more than anything, we hope that you learned something today from this conversation and can make some good decisions with your overall retirement in mind, but specifically in taxes moving forward. So thanks for joining us. Like this video, leave us some feedback, and we look forward to sharing more content like this with you in the future.